everybody. Today we're going to be talking about job costing. This is chapter 4 in the cost accounting book that we are using. And so let's get started. Some of the key points that we're going to be talking about in this class. The first one is, what is a cost object? A cost object are anything that which a measurement of cost is desire. So it could be a vehicle, it could be a computer, it could be anything that the particular company is wanting to measure their costs for. Now, of course, we know that what are direct costs? Direct costs are costs that we can be traced directly to the cost object in an economically feasible way. And then, of course, indirect costs are cost object that can be traced that cannot be traced to a cost object in a economically feasible way. So, those things you should be very familiar with. Now, the couple other things that we haven't talked about before is a cost pool is a group of individual indirect cost items. And then, of course, the cost allocation base, a systematic way to link an indirect cost or a group of indirect costs to cost objects. So those are just a couple of the definitions that we are going to be talking about in the information that we're going to be covering tonight. Now, there are going to be two types of costing systems that we're going to be talking about. The first one is a job costing system, and then we also have a process costing system. A job costing system is basically you are tying your cost directly to a particular item. So it's more like an airplane or a unique piece of furniture, something that is unique to, you don't make it in a bunches. Now, a process costing system is basically for a company who mass produce things like a soft drink or cereal or things like that, where they're on an assembly line and so that they go through very quickly and you can't really have direct costs associated with each individual box or each individual bottle of soft drinks. So the definition that we talk about in job costing system, the cost object is a unit or multiple units in a distinct product or service, which we call a job. Each job generally uses different amounts of resources. And then the process costing is the cost object is masses of identical or similar units of product or services. In this type of system, we divide the total cost by producing an identical or similar product or service by the total number of units produced to obtain the per unit cost. So basically, think of job costing is a more unique system, and process costing is basically you're producing multiples of the same thing. Now, some of the different types of job costing and process costing, what type of companies use these? These are actually located on page 109 in your book. If we're looking at a job costing in the service sector, if you're doing an audit for one particular company, so that's considered job costing. You can easily trace back the cost to that one job. Consulting engagements, so same thing. You're consulting with one client and you can trace all the costs to that one client. Advertising agencies, uh, individual legal cases, computer repair jobs, and movies produced by Universal Studios. So those are in the service sector and job costing. Very easy to keep track of the cost for a particular job. For the service sector on the process costing side, bank check clearing and postal delivery. You really can't break down the cost of, how many minutes did it take a postman to deliver your mail, and how many pieces of mail per house did he deliver. That's just not possible. Same thing with the bank check clearing. They have thousands and thousands of checks that go and get cleared through the bank every single day. So that's just not economically feasible. Now, on the merchandising sector, LL Bean sending individual items by mail order would be considered a job costing. And then, of course, a special promotion of new products for Walmart would be a job costing. On the process costing, we have a grain dealer and then, of course, a lumber dealing by a lumber. So we really can't, especially like with the grain, you just have a huge amount of grain and you can't, this particular grain, it cost me this much to produce. You can't do that. So it's in a process costing type system. Manufacturing sector would be considered assembling an individual aircrafts. For Boeing, you know, you could easily trace all costs to that one aircraft. And then, of course, construction of ships too. You can easily trace those costs to that one ship. Now, in regards to manufacturing side for the process costing, oil refinery, I mean, it'd be impossible for one drop of oil or something like that. And of course, beverage production, you can't really break it down by bottles. So those are just some illustrations of the different types of companies and what would be considered job costing and process costing. So now, when we're talking about the costing approaches, we're actually going to have two different types of costing. One is the actual, and then the normal. Now, when I'm talking about the actual, and this is all involving indirect costs, because of course, direct costs, we can have the actual numbers of direct costs and we can relate it to a product. So this always involves just the indirect costs. So in actual, we are going to be taking the indirect cost based on the actual indirect cost rates times the actual activity consumption. But on normal costing, indirect cost based on the budgeted indirect cost rate times the actual activity consumption. So those are the two differences, and we'll be getting into more details about those here shortly. Now, as I said, both direct methods allocate direct costs to the cost object the same way by using actual direct rates times the actual consumption. So we can tie direct costs to a product, but the indirect, we have to have different types of approaches. We do that. Now, an easy way to look at this and understand this a little bit better is how it's summarized in your book. You can find this, I'm not really sure. It's actually on 2 pages, starting on 111. So, direct cost, of course, that's going to be actual direct cost rates times actual quantities of direct cost inputs. And on normal costing, actual direct cost rates times actual quantities of direct cost inputs. So, for both actual and normal, it's going to be the same no matter what. Now, on the indirect, there's where it differs. On the actual, you're going to have the actual indirect rates times the actual quantities, whereas in normal costing, you're going to have the budgeted rates times the actual costing. And we'll get more in detail here shortly. Now, let's talk about the 7 steps of job costing. These every time you're doing a job costing, these are the 7 things you're going to do. The first thing, of course, you're going to identify the job that is the chosen cost object, and then second, you're going to identify the direct cost of the job. Remember, that's the easiest thing to do. And then, of course, select the cost allocation base to use for the allocating indirect cost for the job. So basically, you're going to just say, okay, I'm going to base this on machine hours, or I'm going to base this on labor hours. Then identify the indirect costs associated with each cost allocation. Determine the appropriate cost pools that are necessary. Compute the rate per unit for each cost. They allocate the base used to allocate indirect costs to the job. Normal costing, so use budget value. So in the normal costing, we're going to use the budgeted. So to find the budgeted manufacturing overhead rate, you're going to take the budgeted manufacturing overhead cost. So what you thought you're going to produce in overhead cost, divide it by the budgeted amount that you think that you're going to make. Okay. So the overhead cost divided by how many you think you're going to make, and that's going to be your budgeted overhead rate cost or overhead rate. Okay. And then, of course, step 6 is compute the indirect allocation or allocate it to the job. So you take that budgeted allocation rate times the actual base activity for the job. And then the seventh step is compute total job costing by adding all direct and indirect costs together. Now, contrasting actual costs, both actual costs and normal costs trace direct costs to the job. So just remember, in actual cost and normal costing, the direct costs are going to be the same. That doesn't change. The only difference between costing a job with normal costing and actual costing is that normal costing uses budgeted. So normal is budgeted, actual is the actual. So keep that in mind. You see actual, you're going to use the actual. You see normal, you're going to use what you think is going to be your rate. So if you look in your book, this chart should be in your book on page 117. And this kind of gives you a visual of what goes on. Now, we have direct materials and direct manufacturing labor. So those automatically go up. And then we have the cost object, specialized machinery. So we're going to take the allocated manufacturing overhead costs divided by the direct cost. And then that's going to be $40 per manufacturing labor. So they decided the manufacturing labor is going to be um, your cost driver. So allocation rate base is the 28,000 direct manufacturing labors. So I'm going to take that 40,000 times, I'm sorry, $40 times 28,000, and that gives me my all the manufacturing overhead costs of 1.12 million. So here is how it flows onto a particular um, uh, company's financials. So we have the period costs, and of course, those go straight to the income statement when you incur them. The inventoriable cost, the first thing we're going to do is purchase the direct materials and the direct manufacturing labor. That's going to be on the balance sheet as part of the inventory. And then we're going to have the manufacturing overhead, including indirect materials and indirect manufacturing labor. And that's going to be in the inventory on the balance sheet. Uh, then we're going to convert those into the work in process inventory. And then if you notice here, we have purchase of the direct materials and direct labor. Those trace to the particular thing, to the particular item. The overhead and the indirect materials and labor is going to be allocated based on our rates. And that goes into the conversion into the work in process inventory. And then once it's completed, it goes onto the or the finished goods inventory. And then when it sells, we take it from the balance sheet to the income statement as cost of goods sold. Now, some of the journal entries that you're going to be using in this, again, you're going to have journal entries in each step of the process. And so, what is the purpose of having all these journal entries? Is to have the accounting system closely reflect the actual state of business, its inventories, and its production processes. So, the first thing we're going to do is all product costs are accumulated into the work in process control account. So, when we're doing these, you're going to be using the word control. Instead of just work in process, we're going to be using control. So, the first thing we're going to do is move the direct materials that goes from the raw materials inventory control to the materials control into the work in process control. And then direct labor, of course, will go into the work in process control. And then what we allocate or apply for the factory overhead will go there. The actual indirect cost overhead are accumulated in the manufacturing overhead control account. So here's the actual journal entries. The first one, of course, is going to be the purchase of the materials, direct and indirect on credit. So we're going to debit the materials control and credit the accounts payable control. Now, then we're going to the usage of the direct and indirect materials into production. So we're going to take it out of the materials control, and we're going to put it into work in process. And then, of course, we have the manufacturing overhead control. And then the third part of this is we're going to have the payroll. We have the work in process, which is the direct portion of it. That goes into that. The indirect portion goes into the manufacturing overhead control. And then, of course, cash control. So if you notice on the second one here, that manufacturing overhead control is your indirect costs. Your work in process control is your direct costs. Okay. Now, the overhead, other overhead manufacturing costs incurred during the period. Um, we have possibly any cost that we actually pay for. So that would go into manufacturing overhead control. Instead of using depreciation expense like we do when we do depreciation, we're going to throw it into manufacturing overhead control. And then, of course, credit the cash and credit the accumulated depreciation. So, in this type of system, you're not going to be using depreciation expense. You're going to be putting it into manufacturing overhead control. Now, the fifth one is the allocation or application of indirect costs in the work in process account based on a predetermined overhead rate. So, if we're doing actual, again, we're going to be using the actual rate. If we're using the normal costing, we're going to be using the normal costing or the budget rate. And so we're going to throw that into work in process, but it's going to be coming out of the manufacturing overhead allocated account. Now, no, actual overhead costs are never posted directly to work in process. Products are completed and transferred out. So, again, in normal process here, we take it out of work in process and put it into uh, the finished goods control. And then once it's completed and it's sold, it goes from finished goods into cost of goods sold. The difference between the sales and the cost of goods sold amounts represent the gross margin in this particular transaction. All right. And then, of course, when marketing or customer service costs occur, again, remember that's a period cost, and it goes directly to their respective expense accounts. It has nothing about any of the manufacturing accounts. Now, uh, and then when we sell it, we have the accounts receivable control and the sales. Now, this particular one, if you look in your book, it's located on page 121. And this kind of gives you some numbers to understand what is going on better. So the first one here, we have purchased the direct and indirect materials of 89,000. And so whenever we purchase this, it looks like we're going to be purchasing this um, on account, I believe. We should be you should have accounts. Yeah, you have accounts payable control. So we're going to debit materials control because that went into materials control. We're going to credit accounts payable control. Now, in the second one, we use direct materials of 81,000 and indirect of 4,000. Now, all 85,000 are going out of materials control. But if you notice here that 81,000 went straight to work in process, whereas the 4,000 went to the manufacturing overhead control. Then number three, we paid the cash for direct manufacturing labor of 39,000 and indirect manufacturing labor of 15,000. Now, direct, you see that here it went into work in process control, and then the indirect of 15,000 went into the manufacturing overhead control. And of course, we paid cash, so that came out of cash control. Now, in number 4, the occurrence of other manufacturing department overhead of 75,000. So that is a debit to manufacturing overhead control since it's an indirect cost, and that should have come out of it went. Some of it came out of cash, and some of it came out of accounts of the accumulated depreciation. So that particular one, some of it was bills that we paid, some of it was depreciation. So again, depreciation goes to manufacturing overhead control instead of depreciation expense. Number 5, the allocation of manufacturing overhead of $80,000. So if you notice here, it comes out of manufacturing overhead allocated as a credit and a debit to work in process control. And then step 6, completion of the transfer to finished goods. So we have 188 in finished goods. So that's going to come out of work in process and go into finished goods. That leaves us a balance of 11,200 in our work in process. The cost of finished goods or goods sold in number 7 is 180,000. So that moves out of finished goods control and go to cost of goods sold. Leaves me a balance of 8,800 in the finished goods control. Now, the occurrence of marketing and customer service expense, again, we talked about that earlier. That is a period of cost. So that's just going straight into a marketing expense and a customer service expense. And then, of course, we paid cash for that. So that comes out of there. And then in step 9, we have the revenues of 270,000. And in that case, we did that for accounts receivable. We billed the guy. So that's a credit to revenues and a debit to accounts receivable control. Now, in the overhead, if you look at this in the subsidy ledger, this is actually located in your book on page 124. That's 124. And so it kind of gives you a better idea of what happens there. And this is just by a subsidy ledger. When we talk about this, this is an individual job. So if you have any questions about that one, just let us know and we can go into more detail in a separate video on that one. All right, now how do we account for the overhead? Recall that there are two different overhead accounts that were used in the journal entries. We had the manufacturing overhead control, which is what we used whenever we actually had the money going from direct or materials or labor or such. And then when we allocate it into the work in process, we didn't use the control account, but we used the allocated. Uh, was credited for the estimated budget overhead applied to the production in the work in process account. So we had two. Now, actual costs will almost never equal budgeted costs. So we have to make adjustments. So if the overhead control account is greater than the overhead allocated, this is called we under allocated. So that means that we didn't allocate enough money into work in process than we should have if the overhead control account is greater. Now, if it's less than, that means we over allocated. We didn't allocate enough, or we allocated too much. I'm sorry. So if the control account is less than the allocated account, then we over allocated. And then if the overhead account is less than, or the control account is less than the allocate or is greater than the allocated account, then we under allocated. Now, how do we get the difference there? This difference will be eliminated in a end of period adjusting entry process using three possible methods. So, what are those three possible methods? The first one is going to be the adjusted allocation rate approach. All allocations are recalculated with the actual and exact allocation rates. The proration approach, the difference is allocated between cost of goods sold, work in process, and the finished goods based on their relative size, or we're just simply going to write it off. In most cases, we're going to just write it off. When management is deciding between the approaches, they should use the following um, guidelines. What is the purpose of the adjustment? The size of the amount that was over or under allocated, and whether the variance was over or allocated. The choice of methods should be based on such issues as materiality, consistency, and of course, industry practice. Now, job costing is really based off of mainly in the manufacturing section, but can be useful in the service organizations, as we said earlier. Auto repair shops, advertising agencies, hospitals, and accounting firms could use the job costing. An accounting firm, for example, like the one I work at, um, we could probably break it down by tax return by the person. We know who we have a control sheet where people will sign off, and so we can allocate their costs, what we pay for them, to that particular job if we wanted to, and then then compare it to what we charge them. Or the most easiest way that you would do it is probably with an audit, because audits usually are bigger projects than taxes, and all the costs could be associated with a particular tax. Now that comes to the end of chapter 9 review. Now I will be putting up another example here. I'll be going through an example similar to your homework assignments in the next day or so. So keep an eye out for there. And the word for tonight for this particular lecture is Cubs win, because I have recorded this on Wednesday night and the Cubs won their play-in game. So I'm excited. So if you have any questions, please do not hesitate to ask. Again, as I said, I will be putting up a separate video doing an example of what you will be doing in your homework assignment. So watch for that here the next day or so. Thank you, and y'all have a great night. Bye bye.